Treasuries earning they're paying about 1.6% yield. Who on earth would want to buy something paying so little when inflation is higher? Well, Jack Hough is here from SmartMoney to talk to us about this, and he says it's still a good time to buy these what seem to some people almost bubble-like prices for Treasuries.
Yeah, but we've been saying bubble for a long time.
And a lot of people got burned on that already, right?
Yeah, you know, over the past year, the 10-year Treasury, right? Yield now is probably around 1.5%. But it's come down over the past year. If you held the 10-year Treasury, you've made a 20% total return when you count the price gain and the little trickle of income. Because keep in mind, as these yields come down, the bond prices rise. So, I mean,
the key point you make, of course, is that the yield is not necessarily reflective of what you're going to earn so long as there's capital gains to be had. And you're saying that the way to take advantage of this is to go long. Explain that.
Well, right now the yield curve is very steep, or what we call the yield curve. It means basically everyone wants the short-term Treasuries. Because everyone's saying the same thing right now. They're saying yields can't stay this low forever. They have to rise tomorrow.
And next week. Some people don't always get bonds. When yields are low, it's a sign that the prices are high, right?
So people are buying, 6-month Treasuries, 1-year Treasuries, and the yields are very low on these right now. When you look at on the longer stuff, 20, 30 years, look, the 30-year Treasury has a 2.5% yield. I know that's not a gigantic yield, but the idea is that it's high relative to shorter Treasuries. If you're one of these people who thinks that the economy is going to be slow for a prolonged period and that interest rates are going to remain low, there are some bond analysts out there who believe that eventually investors are going to come around to saying, all right, look, this is what the world looks like with these low yields. Let's get some longer Treasuries. Now, if that happens, if they buy on the longer end of the curve, you can see this 30-year Treasury rise in price. If the yield comes down from 2.5% down to 2%, that's about like getting a 20% price gain on those Treasuries in addition to the yield. So that's one way to try to get some extra money out of these Treasuries.
What about this barbell trade that you're talking about? How does that play out? What's that to do?
Well, of course, you can get much higher yields in low-rated corporate bonds. The high-rated corporate bonds, the best companies, you're not getting much extra yield there. But if you buy junk bonds, you would. Of course, that's not really an even swap for Treasuries. You're buying Treasuries for safety, and junk, you have a much higher risk of default. So one thing you do to take a kind of balanced approach is sticking in the higher, the better end of the junk bond universe. Go very short with some of these bonds, right? 1, 2, 3, 4 years.
Short maturities,
right? Because when you have these shorter maturities, that's less time there is for a company to fall into financial difficulty. And then with the long bonds, stick with very safe bonds, Treasuries, and the highest grade corporate bonds. And if you do that, you can pick up 4 or 5% on the short end, 3 or 4% on the long end, and it's a way to sort of take a balanced approach with some safety and yield.
Safety and yield, exactly. That's where you're heading with that. I thought one last one you mentioned, adding mortgages, and this interested me because there's a lot of focus right now on what the Federal Reserve might do. Talk about them going for a third round of quantitative easing, and what they have mentioned, it seems, they would actually be buying mortgages. You didn't mention that in your piece, but I wonder whether you could speak to that, because you do say that mortgages do offer some value.
Mortgage-backed securities from these government-backed agencies. Right now, you get a little over 2% on fresh mortgages that have been turned into securities, about 2.2%. The key is you don't really know how long these bonds are going to last, because we don't know how quickly homeowners will pay off their mortgages, but the historic average is about 7 years. 7-year Treasury is about 1%, so you get 2.2% on mortgage-backed securities versus 1% on the 7-year Treasury. It's another way to pick up some extra yield if you want to mix in some mortgage-backed securities into your bond portfolio. You need to use every trick in the book right now to get even that extra 1 percentage point.
Right, with yields as low as this, indeed, that's the case.